Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the first trading week of 2024. This is for the week ending January 5th. I'm Preston Brent. Thanks for tuning in. Well, I guess we're going to be in a market tug-of-war here through the first 3 weeks of the month, January. So we got a lot of data that's going to be hitting the news wires, as well as earnings kicking off the following or this coming Friday. We're going to get some of the banks, some of the key money center banks, Bank of America, Citi, JP Morgan, Wells Fargo, all of those are hitting the earnings newswire Friday morning before the markets open. We're going to get inflation data this coming week, and then we're going to get PPI data, and then we're also going to get the Feds the end of this month. That's going to give the markets a really good indication of where we are with the interest rate hike. I call it market tug of war because the markets are expecting 5 to 6 rate cuts this year, and so far the Feds have only broadcast they're going to do 3 rate cuts. So there's going to be a big battle going on. No one's expecting a rate cut for the month of January. We do not have a meeting in February, and then in March, that's when everybody's looking at what are the Feds going to do. We got one side saying that they're going to cut, and another side saying they're going to hold steady. So all of this is going to start to unfold as we start to get through these first few weeks of the new trading year. So having said all of that, why don't we jump into everything and just kind of see where things are starting to shape up here, and then we'll go take a look at the charts. If we look at the index performance, well, everybody probably knows everybody's in the red for the week. Year-to-date numbers are the same as the weekly, of course, because it's the first trading week of the year. And if you'll notice the best and worst performers, they're pretty much reverse course from last year, pretty much like how we ended 22 and went into 23. The worst performer for the week was technology, best healthcare, and then obviously you can see the year-to-date performance of the indexes, Russell and NASDAQ, well over 3% on the way down. So I think the those sectors that did fairly well outside of healthcare, we had utilities, which was one of the worst performers last year, doing fairly well to start things off. Some of those other sectors that lagged that started off okay, energy, consumer staples as well. So we did see lighter trading volume this week. So not really sure how much that played into it, but clearly after 8 weeks of solid gains, the markets needed a break. So it was a holiday shortened week with Monday being New Year's Day. So we're going to see how things start to really fine tune as we move into the next few weeks. Okay. You can see the PE ratio is still, in my mind, relatively elevated at 21.24, the forward 12-month. The trailing 12-month, they're almost the same. All right, dividend yield fairly low at 1.5. 10-year Treasury, one of the things I noticed this past week was every time the Treasury 10-year moved over 4%, the market equities pull back. And you can see we closed out the week at 4.04%. We haven't been over that in a while. So you can see that. You can see the earnings yield. The VIX was up just a little bit for the week, but still relatively low on a relative basis. Okay. And of course, we did get some economic data hit in this holiday shortened week. We saw the S&P Global manufacturing activity slowing down, ISM coming in just a little bit stronger. Jobs numbers, which was really important, came in at 216,000 in December, well above the forecast. We got monthly growth, hourly earnings stayed steady. The unemployment rate stayed steady at 3.7%. So we're getting, a little bit of a, kind of a mixed message, but not really leaning too strong one way or the other for the Feds to either they got to cut sooner or they are going to stand pat a little bit longer. That'll all start to play out as we get through the month of January, I believe. All right. And like I said, the yield on the 10-year moved back up. We haven't been over the 4% threshold since about the middle of this past month in December. So that tug of war is going to really play itself out as January unfolds. And until we get the January 31st Fed policy decision and Boom Boom Powell step in front of the mic to see what he's got to say. Okay. So a lot of activity coming up for this new year. If we look at the European markets, Everybody's in the red here too. Euro stocks, FTSE, CAC 40, DAX, all across Europe in the red. Weekly and year-to-date numbers, of course, equal each other because it's the first week of the year. We had a little bit of a reacceleration of inflation across the Eurozone in December. So that kind of put the kibosh on some of the expectations for early rate cuts by the ECB, or at least made it a little bit less likely. Um, we did see annual consumer price growth. It rose about 2.9%, and it was at 2.4% in November. So we're seeing some of that back in there. Core inflation eased just a little bit from 3.6 to 3.4, but still well over the 2% level that the ECB would like to see. So I just don't see, I think the markets are getting a little bit more exuberant than they should as far as expecting these rate cuts. Remember, the big key for me is when the Fed start cutting rates, why are they cutting? Is it because they can or because they have to? If it's because they have to, that means the markets are not doing very well. We're starting to run into a little bit more of a harder landing recession-wise, and everybody wants to know we're going to have a recession this year. I remember that was the same question when we kicked off 2023. Are we going to have a recession in the summer or the fall of 2023? Didn't happen, okay? So it'll be real interesting to see. We'll get more data that's coming out. It would only be just a layman's guess, anybody, on whether we're going to have a recession this year or not. I do believe we will have a big market event over the next 2 or 3 years. And I think we're going to have a huge pullback. You know, it's going to probably rival and go further than what we saw in 2022. And there are a number of potential things that could set that off kilter and move the markets lower, but no need to speculate right now. Okay, so but we do have this tug of war going on in the markets with the Feds and the markets, and we'll see which one of them is going to be right, which one of them is going to be wrong. And as we play it out, we'll see it. So that's what's going on across the European Union. And of course, if we go to the Asian markets, everybody is in the red there. China's still hurting, down 2.29% for the week. Hang Seng 3.22. Over in Japan, a little bit of an earthquake prompted a potential debate on the early exit of the Bank of Japan from its negative interest rate policy. They're saying now maybe it'll be delayed because they got to put some money into the economy. So that pulled the yen back pretty good little bit, falling to around the 145 yen to the dollar range. So we'll see how that plays it out. But I still believe longer term, the yen's going to be a great long play. All right. The yield on the 10-year pretty much held steady all week around 61 bips. Then, of course, China, they're hurting. All right. Stocks in China, there's persistent concerns about their economy. We did see the official manufacturers PMI come in contracted for the third consecutive month. It was like around 49. So anything below 50 is contraction instead of expansion. And the People's Bank of China injected about 350 billion yuan via their what they call their pledge supplemental lending program to banks to help shore up some of the property sector. At least banks provide money or loans and shore it up. So I think the housing and the real estate markets are going to continue to drag in China for a little bit of time here. So that's going to weigh eventually on the global economy in the first half of this year, I suspect. Now, if we switch over, I'm going to show you the charts here. Let's just quickly go through this. Let me get it over here to the E-mini S&P 500 futures. Right here. Here we go, right here. That would be that one. And you're going to see here the reversal in price. And it takes about another 5 seconds to come up on the screen. So I'm showing, you can see it now. You can see this yellow dash line was the former all-time high. And then we made new all-time highs, you can see over here on December 28th. Right as we finished out and closed out last year, we're up a little bit, just around 25% for the year, 24.65, I think to be exact. That was an intraday high. And then you could see here how we pull back since then, just steadily. This is a daily chart, but we pull back here. We're still well above the 50 EMA and the 200 EMA. 50 EMA, I do believe we're going to settle down a little bit more. And then you could see here, there is no divergence in the MACD, so that does suggest that we're still in a buy the dip mode in the E-mini S&P 500 futures, right? So that's a little bit about what I'm seeing there on that. And then, of course, if we come over here and we look at NASDAQ, you can see NASDAQ, it hit its all-time high back over here on December the 28th as well. And that was the former all-time high that it took out, which was made way back in November 19th, 2021. So it finally made new all-time highs in NASDAQ, and then we've just been pulling back since. I do believe we'll probably see kissing the 50 EMA here shortly. And we'll just kind of see where the market action wants to take us in NASDAQ, right? And then, of course, if we look at the Dow futures actually made a new all-time high on the first day of this year. You can see over here on, let me just see here. It was actually on this date right here, January 2nd, right? Or yeah, I guess it was January 2nd for the Dow. So let me just change that here. And that's kind of where we sat. Dow was the only one that made new all-time highs. And that would be 2024 right here. And that would be January 2nd, all-time high in the Dow, right? So, and we're not going to count that right now because that's not where it's sitting. So we've got a high price here that is all-time high. And we'll get that all set up. And you can see the former all-time high was right here on January 5th, 2022. All right. So we're making these all-time highs in the Dow. And as we move forward through the month of January into February, I will set up our opening price, our high price, and our low price for 2024. I always recommend any asset class that you want to track, always have the opening price of the year, always have the high price and the low price for the year in that trading year. And obviously the first week it's hard to do because they're all fairly close to each other. It kind of crowds the chart. But as you get moving out, you want to update those things because those tend to be support and or resistance points by a lot of rat brain traders. And because it is, we want to follow it and just make note of it. So the Dow has also been pulling back just a little bit, but if you've noticed, not as much as some of the others, right? Now, if we look at the Russell made its all-time high, or not an all-time high, but a 2023 high on the 27th of December. And it's pulling back close to the 50 EMA as well. So I do see a little bit more of a continuation of this drop. We may have a little bit of a counter move Monday or Tuesday of next week, and then maybe a little bit lower. Now, we do get some key data coming out next week. We get the CPI data hitting on Thursday. So if it is an ugly print, we're going to go down a lot more. We'll probably come down a good bit, test the 50 and then the 200. If the CPI data shows inflation, yeah, it's slowing, but not enough. But if it just comes in kind of flat to just wandering around, we're going to continue with this low vol chop kind of environment. Okay. And then, of course, if we come over here, let me just see if I can find it. I think we've covered pretty much what I wanted to show you here. If we come back up here, and let me just show you the Magnificent Seven. You can see here on these 7 stocks, it's a custom index. We made highs over here. Let's just move it down a little bit. You can see we made a high price here on December 28th, and now we're coming down and testing the 50 EMA just perfectly. You can see that MACD cross right there. It's a perfect bearish divergence. It's a perfect signal coming into the first part of January, how we've had a shift in the momentum, and that's where we get the, that shift is showing, some of the stocks that lagged in 23, like utilities, staples, healthcare, energy, have been leading the way in this first week. Now, will it last? Not really sure. But we're seeing some profit taking in some of the Magnificent Seven. And by the way, if we just look at the FANG index, the stocks that make up the FANG index here, it's another custom index that is the FANG index. You can see it is also coming down as well. Perfect bearish divergence on the MACD, testing the 50 EMA. So all of this just makes sense to me, right? We may have a little bit of a bounce and then a rollover. We'll see how this is, but you can't move up that strong. I think last year I was up a little over 80% for the FANG, and even more than that for the Magnificent Seven. So we're going to see a little bit of a consolidation quiet period until this thing gets sorted out. And if we look at the ratio chart of the equal weight in the SPX, you can see here really going back to the middle of October of last year, equal weight, all those other 493 stocks, not counting the Magnificent Seven, have been coming up very nicely, right? So that is a good sign that the breadth of the market is starting to expand a little bit, right? And if we look at just the equal weight, you can see how the equal weight really starting, in October, but really in the middle of October, it just took off. And we had a 2023 high price here on the 28th of the equal weight, pulling back just a little bit, but outperforming most other stocks. So that is where I see some opportunity in 24 for those of you stock pickers and folks that are managing a 401k or an IRA or some kind of retirement account. Okay. So that's a little bit about what I'm seeing here. And of course, if we look at volatility, what's interesting here is you can see vol came down on Friday a pretty good little bit. I mean, the markets were up only 6 points on Friday, the S&P, but the vol is staying solidly in the green. When it's down in this area here, I was telling our members to pick up some out of the money puts, very cheap. And when hedging and deep out of the money puts are cheap, you want to pick them up, right? Because typically that means that you're going to get some kind of movement in the volatility. And we haven't been this low in VIX since right around COVID times. So I think that this is going to I don't think we're going to see a big move higher in volatility for now, unless we get a surprise in this Thursday's inflation data, right? Or we start to see surprises in earnings. Because at the end of this week, like I said, we get Bank of America, Citi, JP Morgan, and Wells Fargo before the markets open. So big money center banks will get an idea. Most people are not going to be focusing on current Q4. They're going to be focusing on forward guidance. And banks are really good at in their conference calls, how's the consumer holding up? And we got to watch what the consumer does. That's going to be very important. Treasuries, well, if we look at the bond market, let's get the bond market on here. Here we go, right here. You can see the bond market. We've been moving lower, which means interest rates have been moving higher. So as the markets have been going down, right, bonds have been moving down with the markets as interest rates have been moving higher. Remember, when bonds move lower, interest rates move higher. And if we look at the 10-year, right, if we look at the 10-year interest rate right here, you can see here, after that low that it hit almost the tail end of last year, it's taken off, and it's moved up a pretty good little bit. But we're well off on the 10-year interest rates, these highs right here. So I do believe that right now it's gonna run up a little bit and then roll back over for now. So we'll have to follow that very closely on the 10-year interest rates in the bond market. Currencies, US dollars a little bit stronger with that move higher in interest rates. You can see here they're kind of moving in tandem. But this is a sell to rally just like the interest rates right now, right? Any movement much higher, you're going to want to sell it because I think the dollar is going to go lower. But our trade is not really as much the dollar as it is the euro, right? I was talking about getting long the euro way back over here. Any pullback here, and then there was another entry point over here for the euro. And you can see here we made a higher high, just really a very minor amount of divergence here that would suggest a little bit of a pullback. I don't think we're going to get too much here, so this is a buy the dip moment here with the euro. Pretty much like what we're looking at for the markets right now, although I'm not ready to suggest next week. I would wait before we get through some of this inflation data and these earnings data on Friday for those of you that are stock pickers out there and moving stock, doing something like that. And of course, if we look at gold here, gold is, let's get gold up on the screen here, right here. So if you look at gold, it's just kind of, I think it's in a sideways move. For our members, you know how we like to trade this kind of movement here. 50 EMA seems to be the point of support, at least, and you can see the MACD is staying fairly above zero, going all the way back to October of last year. The MACD, if it goes slightly right at it, crosses above. So if we go deeper into that, then it'll be more of a neutral to downside on gold. But right now, it's just trading. It's doing the porpoise. It's just doing a sideways movement. Okay. And then, of course, if we come over here and look at copper, which is tied a lot into China, you can see here we broke out of this 2022 move right here, copper in China just going down. We broke out of it, but I do believe this is going to be a buy the dip opportunity in copper right here, but I'm not sure if the dip is done yet. Right, it may come down a little bit lower for those of you that are looking at copper. Now, copper tends to follow the global markets. If we do come out and we see stronger growth globally than expected, expect copper to move up. When China finally gets their act together and their economy starts to stabilize and starts to see growth, you'll see copper move up nicely. Okay, until that happens, it's going to be this is a very tight channel moving higher, but I think this is going to start to run sideways for a bit now. Okay, with copper. And then, of course, if we look at oil, oil is in a, you can see right here, this is, I don't see oil going too much lower than this. Um, and I don't see it going too much higher than this either. The 50 crossed the 200. So that just tells me right now that oil is in a little bit of a sideways pattern. You could see this is a sell the rally in oil. You could see how it rolled back off the 50, back down again, and then it's going to make another attempt here. We got great ways to trade this in our group as well. Members, I'll talk about that this Sunday evening in our weekly roundup. Okay. So that's a little bit about oil, nat gas. Well, remember what we did for nat gas. I think some of you took the trade. I got some emails from some of you. This was a perfect credit spreads, bull put spreads, almost most of last year. Okay. Briefly down here, we were trading flies, but I converted it to bull put spreads, and it was a great trade pretty much all year long. And then right up at these levels up here, I said take profits. Once it broke here, we've shifted, and right now we're in a sell the rally. This is and remember, we're going into the winter months, so nat gas tends to get a little bit more bullish in the December, January, February timeframe. And that's kind of what we're seeing here. But I do expect this to kind of run out of gas, no pun intended, relatively soon. And then I think it's going to roll back over again. All right, so that would be nat gas. All right, everybody, that's a little bit of a quick and dirty on how the markets are shaping up as we go into the first week. Members, I will see you Sunday evening, and we'll go into a little bit more detail on some potentially specific stocks that are worth taking a really hard look at, as well as a little bit more detail on some of these charts and what we can expect as we go through January into February of the first quarter of 2024. Have a great time, everybody. You football fans going to have a great football game Monday night for college football. And then we got the pro playoffs getting ready to take off here shortly. Have a good weekend, everybody.